Our next corporate then, Cummins is the stock that is in focus. Macquarie, well, they are bullish on the stock with an outperform rating. Keep in mind the stock has been buzzing this year. It surged more than 90% odd. So how is business momentum and how the outlook from here on? Well, we're joined by Mr. Ajay Patil, the CFO of Cummins India. Hi, Mr. Patil. Good morning and always good to have you on the show. Let's start off with focus on CPCB4. That's finally seeing the light of day. So how is demand for CPCB4, given that, for the buyer, the prices go up by close to 40-50%, a rough estimate out there. How is demand on ground and how's the competitive intensity?
Hi, good morning to all of you and the viewers. Always a pleasure to speak with you. I think, yes, the transition is now July 1st of 2024. So we got an additional 1 year, which was granted last year. What we have seen throughout the last fiscal year is a good, interest and demand for CPCB4, while the customer still had a choice of buying the CPCB2 products, which is a function of how we got our products ready on time last year. So we had our products ready as per the original deadline. And we have seen that interest and demand come throughout the year. Now that we eventually transition to the CPCB4 Plus from July 1st, we do expect that the demand momentum to sustain. While always there could be a period of transition, maybe a quarter or so, just because there will be inventory liquidation which would happen this quarter, which might have some impact in the following quarter. But generally, directionally, we don't see any potential impact from a demand perspective. The second point you touched upon was on pricing. Clearly, we are looking at a step up in terms of the product and the technology. And therefore, there is a price impact that we have seen. Our experience of last year is that the price point that we have offered was something which resonated well with the customers from the value that we offer. However, the price discovery for the CPCB4 Plus, now that most players would have their product ready, would be a function of the next 2 to 3 quarters, is how we are assessing the situation.
Mr. Patil, hi, morning. So you're saying that pricing will take some more time to settle. Is that what you're saying?
That is right. That is right. Because as players come, I think the discovery process will play out in the next 2 to 3 quarters.
Sure. Okay. And post the 30th of this month, you can't sell the older products, right?
That is correct.
Okay. Now, Mr. Patil, just talking about demand drivers, what we, globally, one of the big sort of drivers is data centers, right? Could you tell us where are we? I mean, how much is data centers contributing to your revenues right now? Is that going to be the big growth driver with sort of plans afoot for building data centers across the country in a very large and aggressive way? Just give us some color, sir.
Definitely. I think it has emerged as one of the fastest growing segment. And in our assessment, I think it is going to be a multi-year, if not longer, in terms of how this segment is going to play out. I think the underlying rationale for why data center growth is there is well known in terms of how the digitization and the way in which the economy is transforming across multiple sectors. Take it from supply chain, e-commerce, banking, financials, or even the B2C forays that most companies have. Keeping that in mind, what our assessment is that given the need and the on-ground installation that we have, the pace of growth for data center as an end market will continue to be in high double digits, is what we think. At an overall data center level, not necessarily from our revenue perspective. What we have seen, though, in the last couple of years, that it is one of the fastest growing end market for us. And we are well positioned relative to the product that we have and the technologies that we offer on the reliability that is demanded. And therefore, I would expect for our revenue composition as well as a generic data center as an end market, it's going to be a multi-year foray.
Okay. More questions on data centers in just a bit, but I just want to, go back to the CPCB norms to understand, sir, what we see in the auto sector usually, for instance, whenever there's a transition to the next norm, next stage, BS5, 6, etc., there's a lot of pre-buying. Is that evident in your segment as well? So like April, May, June, has there been additional sales before one moves to the new set of products under the new norms with much higher pricing? And typically, the average pricing, how much higher is it as of now? I mean, if a customer is to come to you on July 1st for a product in the same category, with the newer norms? How much is the price increase?
Yeah, definitely the pre-buy phenomena we experienced last year same time. Because as you recollect, the original deadline was July 1st of 2023. And which means the quarter of April to June 23, we had seen an uptick on the pre-buy. I think somewhere towards the end of June, the deadline was extended. And therefore, what we have seen throughout the year is that the demand sustained on the CPCB2, and we continue to sort of position our product and got good response and good sale for CPCB4 in the last fiscal year. Having said, what we are experiencing now is really a phasing out of inventory, I mean, from this quarter perspective, because the pre-buy phenomena has played out in April to June 2023 quarter, as well as throughout the year, is how we are seeing it.
So that's important, because that means that, I mean, we're only looking at quarter to quarter and how we need to analyze the numbers as well. So that means the base quarter already has sort of higher sales because of the pre-buying that happened last year, as you're describing. So that's one. And now there's been inventory liquidation. So to what extent have prices come down? Because, of course, companies are, finally getting rid of inventory. Coming back to that point on competition that Nigel was raising.
I think the pricing is more important to see what the pricing differential is going to be for CPCB4 Plus, because we are talking about a step change in the technology. We are talking about all electronics engines which are needed to comply to the new emissions. And therefore, in our assessment, and it is a broad range of products we are talking where the emissions are applicable. As we know, the emissions are applicable up to 910 kVA product. And the pricing, depending on which node and application, could be in a very broad range of between 15 to 40%.
All right. Mr. Patil, I wanted to ask you about the distribution segment. I think that's around 10% of your mix?
Not necessarily 10%. The total revenue level, I think it is a little more than 10. It's closer to 22 or 25%. 22%.
Okay. All right. And that's growing at a faster clip, and I believe that's relatively better margins?
That is correct. I mean, our distribution business, which is parts and services, obviously has a higher return. And it has been experiencing a pretty strong growth as a function of how we are focused on this business over the last 3 to 4 years.
Okay. So what kind of growth, sir, can you guide for this distribution segment of your business, which is parts and services, which, as you say, is around 20% roughly of your business mix? Will it outgrow the business, and what is the pace of growth you're looking at?
I think if you would have looked at the last 2 to 3 years, it has generally grown in excess of 20%.
Yes.
I think what is important to know is that the way our distribution business is positioned, when we sell out the first product, that requires a substantially long period of services and maintenance. And the number two, we being in the country for past 6+ decades, our install base is very large. And what we are really focusing on as to how do we continue to drive a stronger penetration on the install base that we already have, and mining that install base and converting into some service relationship is really the emphasis that we have been giving. And we continue to hope that we maintain the growth rate.
Okay. All right. Mr. Patil, you have given us a fair idea about business. Now I'm looking for a couple of numbers, and I hope you're going to help me out with that.
Sure.
Exports has been a bit of a sticky region because geopolitical risk, you have supply side issues as well. So in which quarter do you believe exports get back to the normal contribution? I think they came down to high teens, in the last quarter or so because of the pressure that we saw. So by which quarter? Is it a story of quarter 2, quarter 3? And also margins. There were a couple of one-offs in the past quarter, and the street was very excited about that. But then you all clarified on the con call. So a rough margin guidance, and when do exports go back to what we have seen in the past?
I think exports, what we have been very consistently providing the commentary over the last years is really a function of 3 or 4 factors as to why the end market demand was softer. In our assessment, what we believe is that the exports demand is kind of coming to towards the end of its bottom, and we expect it to sort of rebound. Now, really, the most important question is, what is our assessment of rebounding, whether it can rebound in 1 quarter or 2 or 3 quarters? I think that's a difficult one. But if you see the composition of exports that we have between low and horsepower, high horsepower products, I think on the high horsepower side, we are already seeing some sort of a rebound of demand. Low horsepower, we believe, might take some more time. Hard to tell exactly how much a period it will be. But we do see the exports, slowly rebounding back to traditionally where we have been always maintaining from a revenue profile of our domestic and exports. Number two, you asked me about margins. I think, consistently over the last 2 to 3 years, our emphasis on margin has been there. And what we continue to really look at margins in really a 3 or 4 manner. One, as to how much of pricing we can extract in terms of driving our margin expansion. Number two is with respect to a very disciplined material cost management that we continue to do. And then, of course, the obvious element of how we continue to manage our discretionaries. I think a combination of that has really, helped us maintain a very strong momentum on margin expansion. And our endeavor is to, continue to sort of hold and improve on the level of margins that we have. Already, sorry to come in over there, but that's what we're trying to understand, because the exit margin at the end of FY24 Q4 was at, I think, record levels, 23.5%. But then you said that there are some headwinds with respect to material costs. So now I'm asking full year numbers, revenue growth as well as full year margins. What should be a reasonable expectation to have? I think on the revenue, we have already guided that we will have a double-digit growth rate for this year. That's the guidance we have already provided for. Margin guidance we haven't yet provided for a reason that we continue to see some, uncertainty and volatility with respect to how the commodities. We would have observed that the copper and aluminum has run up, and so is some amount of disruption when it comes to global supply chain. So therefore, we are not guiding on the margin side, but I think on the revenue, we continue to maintain that we'll sustain the double-digit growth momentum.
All right, Mr. Patil, we'll leave it there, sir. Thank you very much for your time. Great to speak with you. Appreciate you joining in with that perspective. Good luck, sir. We take a quick commercial break here. We have Mr.